Good morning, ladies and gentlemen. Well, as I've been telling you for the last couple of weeks, this risk off in the model is highly suspect, and I told you why, and it's because it's XLU is outperforming everything, and that's normally a risk off sector, but it's not working, and it makes sense to me that the score actually is now rising. So I would have thought within the next couple of weeks the model will go back to risk on if nothing changes. Something is likely to change this week because we have the Nvidia earnings, so either we're going to have a burst in tech or we're going to have a setback in tech. And as we all know, tech is a leading indicator of other sectors in the market. So let's see what happens, and let's examine some levels which are going to be important in a week which really is devoid of data, and so is likely to be in everything but equities, and especially NQ is going to be a sideways week. With all the data that we had last week, including retail sales and CPI and PPI and another set of unemployment weekly claims, I really hoped that we would get some movement. But what happened? The data was ever so slightly weaker than expected. The market built in a very small probability of a June cut, and then by the end of the week it basically gave it back. The market has decided that the data that we're getting on inflation is just not strong enough to give the Fed confidence to cut in June, and therefore the price cut is in September. It really makes no difference whether this is in December or whether it's pushed out to next year and we get the 3 cuts into next year. But it seems that now we're settling in for the FOMC that we're going to have on the 11th and 12th of June, because we don't really get any more inflation data until then. CPI is going to be on the 12th, which is the same day as the FOMC, when we also get the new dot plots, and basically the market is now deciding whether we're going to have 1 or 2 cuts in those dot plots for 2024. Not that it makes much difference, because the only thing that would make a difference is if they take it away completely and not punt it into 2025. So this is a realistic expectation of what we can look forward to, and the market is priced within 4 or 5 basis points throughout the curve of that. It's very unlikely that next week we deviate much from this. My beliefs are, and I will just go through them once more. Chairman Powell has told us in clear terms that hikes are off the table. Therefore, the only way that twos can move past 5%, so if they ever get to 5 to 5.05%, that is their absolute ceiling. And the only way they can move down in yield is if the data is truly weak and they start bringing forward these expectations or increasing the number of them. That is not going to happen until we get data which justifies it, and we've had a slew of FOMC participants, governors, who have basically told us that last week in speech after speech. We're going to get Waller again. We're going to have Powell today as well. So let's see what they say. But what can they say? I think they've all agreed that the data is not weak enough for them to cut, and therefore inertia just takes over. They are just gathering data, and that increases the odds that when they have to cut more than expected, because they'll be behind the curve. They will be late And when the data shows weakness, it's already too late. If the data shows strength, it's also already too late because it'll just continue. So this is one of those periods that we have to endure before the next powerful trend emerges. Let's have a look at what happened to the individual tenures. This is twos. Basically, they are very, very slightly lower than where they started the week. And that's because they're stuck. I think it's going to be very difficult to force the twos below 475 without data. And it's going to be almost impossible to get them above 5% without I don't know what. I think that in this area, twos levered long is just a gift. Very, very unlikely that any kind of data can be strong enough to push them through there. Fives, well, they had a bit of a better week than twos, but nothing to write home about. I think that the likelihood is that we see this 452, 453 area again, and then just trade sideways until we get some data that pushes us out of that range. Same for the tens. I think they will trade 450 again and will be, stuck for the nth time there this quarter. I just can't see much happening to the bond market next week simply because the data is not going to be powerful enough to move it. The yield curve is doing, it's something that I don't understand. I mean, I do understand it, but I just think it's a short-term phenomenon in which it's slightly flattening as opposed to doing the steepening. To me, it's only a question of where the steepening occurs from, because as I don't tire of telling you, the supply is going to be constant and increasing, and if 2 years are stuck once they get to that 490 to 505 range, then the only thing that can give way is the longer duration and the yield curve steepens again. Do we see 444? I find it difficult to believe that we'll see much more than 443, and I will try to fight it there. I know that my positions are underwater. I know that the yield curve is not steepening. I know that it's flattening, but I just see no alternative to eventual steepening. I just can't see how it can be any other way, because once the twos are stuck where they need to be, i.e. that 480 to 5 range, the only thing that can move is the longer duration, and I don't see how longer duration can move in any direction but higher in yield. The MOVE index also got absolutely slammed, and that tells me that my conclusion that we are unlikely to see much of a range in bonds next week with the data that we have is correct. The MOVE index is finally breaking down seriously, and every time it gets into the hundreds it's slammed. So eventually I think slowly we'll go back into the 80s, and you're basically looking to sell volatility in bonds because it's just not going to happen. Once twos get pinned, then the rest of the curve can do very, very little, and volatility has to continue to come down. What is interesting, and let's try to put this together, is that the ECB has almost told us that they will ease in June, and yet not even the 2-year note, the Schatz, can make any headway up in price or down in yield. We are basically stuck at 3%. Give or take a few basis points, and it doesn't want to move in anticipation. What's even more interesting is that the 1 year is not moving either, or the 6 month, or the 3 month. Now, What can that tell us? That tells us that probably the markets, and I mean the US market as well as the European market, is realizing that this cutting cycle, the terminal rate of it, is going to be actually quite high. Policy might be restrictive, as all the central bankers tell us, but probably it's not very restrictive. And the cutting cycle, unless something breaks, is going to be shallow. That is why I can't see any alternative to a steepening yield curve. Why would you be buying fives and tens almost where they are going to be at the end of the cutting cycle with a positive curve? It just doesn't make any sense to me. And if you look at twos, fives, Germany, they are not flattening, they are steepening. If you look at twos, tens, they're not flattening. If you look at twos, thirties, they're not flattening. It's all very stable. That to me tells me that Europe has probably got it more right than the US at the moment. The cuts, when they start coming, and they are probably going to come in June in Germany, or the EU zone in general, are going to then predict a much higher terminal rate than the market was thinking even in, let's say, 6 months ago or 4 months ago at the beginning of the year. So that tells me that eventually the drip of constant issuance in the US has to have an effect on term premia, which now are negative. Negative term premia and a higher terminal rate just don't go together. It just doesn't make any sense that you can keep on buying long duration paper in the US with negative term premia and much higher duration. And it just cannot be that rates remain at these levels over the longer term. The curve has to steepen. What is interesting to note, and I don't really have an explanation for it, is how much the differentials between Germany and the US have come in. And this to me makes very, very little sense. And I think it's probably going to be time to start fighting it once we get to this 182 to 178 area. That should be a very interesting point to start fighting this, simply because it just is beginning to make no sense. You have one market where the carry is going to be better as they cut rates at the front end, and you have another market which is trading at negative term premium and which has enormous issuance. To me, this is going to be a good opportunity to actually look for a reaction back towards 2. That's 20 basis points. That's well worth having. That's like 10%. This is what I'm looking for. I'm looking for this 182 to 179 area to get in and see if we can't get a reaction higher. As those interest rate differentials that I've just showed you between Germany and the US continue to come in, the dollar is weakening as it should. So where can we see it stop? Well, this is a daily, and you can see that we are at the bottom of the Bollinger Bands, which indicates to me that it's going to be very slow progress getting down to, let's see, 103, 80, 70, 80, this kind of area next week, and that at some stage we could easily get a reaction back up to 105, 105.10 before down again. And basically we are going to just trade around in this range between 102.60 and 105.10. That seems to be the range for the next few weeks, and the doldrums of summer could be here. But that tells me that the likelihood of picking up, of the trade being profitable if you get into that spread between Germany and the US around that 178 area, is quite high, because the odds of reactions higher are very good, as is seeing that level, because I do think that we will trade in the dollar around these levels. And if we can match these levels in the DXY with that spread in Germany 10s, US 10s, that makes sense for reaction higher and therefore a higher differential. In terms of Euro USD, nothing here to tell me that we are moving into a new trading range. I think the trading range is still the old one, with 109 something, 50, 70, 80 as the high, and this kind of 106s as the low. So until that changes, and I don't think it's going to happen anytime soon, then that is all you can look forward to. And that also tells me that the differentials are not going to move that much. We're not going to start busting in the differentials in the bonds to new trading ranges, and therefore, picking up bunds against 10-year notes at those lower levels makes technical and fundamental sense. Gold struck exactly to the level that I thought it might trade last week, just above 24.25, 24.30. What do I think of it now? I think it's unlikely to start breaking up higher immediately, but I think this 23.67-70 area is going to be very difficult to break on the downside. So I'll be a better seller of puts on dips rather than anything else. I think that the differentials between gold and equities and bonds are beginning to look interesting, and let's have a look at those instead. This is gold over SPY, and really, we are more or less at the same level that we have been since for a long time. I mean, basically the last 2 years. We haven't really moved, which tells me that equities have not really rallied in real terms if you say that the deflator is the price of gold. What that tells me is that, gold is not such a bad asset to own after all. It has, it considerably lowers your volatility of return. GLD over TLT keeps on doing steps up. So it looks to me like this is going to break higher and go higher eventually. The one I can't understand is GLD over TIP, and that's one I would avoid, because to me 2% over CPI is always going to be better than zero. But this is the one that I'm going to concentrate on. It is quite likely that at some stage we retest these upper levels where we were in the middle of last year. It seems to me more than likely that gold will have yet another leg higher overall, and this is the sort of long-term chart. All we did is we got to a slight, we didn't even get to the retracement that we could have got to. And now we are, we've made a new high in terms of close. What it's likely to do is spike, come back, and then go. That would be my favorite scenario. But that tells me that puts around these levels, around 23.60 to 23.30, are what you need to sell to take advantage, of harvesting some premium, but also you want to be long at those levels should you get exercised. DBC is finally showing some signs of life. That, I think, is potentially significant for longer duration bonds. They could finally get sold on the back of it. So let's enlarge this chart and let's have a look. This could have been a weekly bear, bull flag, and now we could go and test this 2440 level that I think is so important. And really this has been trending up since the beginning of the year, or at least holding very well this 2175, which tells me the likelihood is that we break higher, for the year. This will be a new high for the year, and that is basically a very bullish sign for commodities and gold eventually, and really quite a bearish sign for longer duration. For DBC to start breaking higher, oil has to contribute because it's like energy is 60% of DBC. It's showing that it doesn't really want to trade much below these levels around the 76, 77 area. And really, what are we looking for? We're looking for a fill of this gap around 82. That would be all I'll be looking for next week. Fill up to 82, from 80 to 82, that's $2. Thank you very much indeed. And that should enable DBC to go up to that 24, 30, 40 level. That would be great, and that is where you abandon the trade. Let's start the equity review with my clean chart, and really 52.55 is going to be absolutely critical to the downside. No way can we have any kind of a correction unless we close below 52.55, in which case 51.80 is the likely target. Now, given that we have Nvidia earnings on the 22nd, we are unlikely to be below there by Nvidia earnings after the close on the 22nd, which then gives us a swing point. If after Nvidia earnings we open below 52.55, we are definitely likely to correct down to 51.80. If we don't, we are definitely likely to go significantly higher. And how much higher, really, that can only be determined by the weekly Bollingers, and those are going to be around 53.90 to 5400. And this is very visible even on the short-term charts. This 52.62 here is going to be the support until we get Nvidia. If we then start breaking down, I think it's very likely that we trade all the way down to the bottom of the Bollingers and these moving averages, which is like 51.40. So it's going to get quite volatile. And on the upside, all we do have is the top of the weekly Bollinger Bands, and we might even go and spike them by a bit. So the top of the Bollinger Bands, and they haven't opened for this week, they will be higher. 53.80s. And we spike it up to 5400, which takes the futures 10-15 higher. So do not be surprised if Nvidia earnings are good that you see above 5400 in the futures. Of course, the Nvidia earnings will mostly be reflected in the NQ. So let's have a look at the position there. The weekly Bollinger Bands are going to be 18,900, call it. My argument would be this: if Nvidia earnings are stratospheric and the market can get up to 18,900, what is the likelihood that it then collapses from those levels? Sure, it might retrace, but why would it collapse? And then look at what the monthly chart looks like. Becomes quite bullish. It's a new leg up, which basically would give us 2 or 3 months more of upside in the NDX. And you can see where the Bollinger Bands are. They're 19,500 now on the monthly. And I see no alternative to tech giving us another lead in equities higher. So I think it's going to be very important what the earnings are. And I don't think that for the week you want to really hold positions much higher than 18,900 on the long side. If you see above 18,900, just take profit and wait. But once that happens, if it happens rather, then the close of this monthly bar is more likely to be at new highs than not, which gives you another potentially bullish 2 to 3 month move, possibly even up to 20,000. So don't discount it. But let's also have a look at what could happen in the other direction. I can't imagine that Nvidia earnings are going to be dreadful. The only thing that could happen is that you get some kind of a retracement on the back of it, a technical retracement that people said, well, you know, what are you going to do for me next? And then what is going to happen? You can see how on Friday it just touched this level perfectly. And this level is here at 18,450 odd. If we are below there and we're starting to fill these gaps on Nvidia earnings, the likelihood has to be that we go and try and fill these gaps all the way down to 17,650. That has to be the likelihood. Just as I showed you in the S&Ps, that has to be the likelihood in the NQ, and basically build up a new head of steam from these levels to go higher. I think it's worthwhile seeing a long-term chart of VIX, just so that you can see how low it really is. Well, it's never really traded or stayed anywhere in single figures for very long, and we are at 12. Since, what is that, 2018, it has never stayed below 1125, and we are at 1199. And on a weekly basis, it's always traded higher than that. Now, I'm not advocating a long VIX position per se. All I'm trying to say is that with volatility at these levels, not shifting your equity plays or holdings into calls or puts makes very little sense. You should be substituting your positions, your long-term, short-term, whichever term positions, into options, because it just doesn't make any sense not to. And with that, onto the levels. I've updated everything that needed updating. What am I going to concentrate the week on? I'm going to concentrate on DBC and selling some puts in gold, short-term puts in gold around that 23.50-60 area. That is about it. What I want to see if we can get below 182 to 178 to 182 area in the tens differential here, and that is the only other trade that I would like to do. SPX and NDX, I told you the levels, they're going to be very important. We could have a very big week, because especially in the upside, because I think the targets to the downside are unlikely to be, unless earnings for Nvidia are disastrous, and I can't imagine that they will be. The downside is going to be well bought. It could take several goes to achieve the targets that I've given you, but there will be buyers. So I'm more inclined to think that we spike to the upside rather than we spike to the downside. But immediately after Nvidia, I shall know and I shall tell you. Thank you very much indeed, and tweet you tomorrow.